First of all, I would very much like to thank the Pro-Vice Chancellor for a very nice introduction, which I'm currently blushing from. Thank you very much. And I would like to just, before I start, thank my colleagues in the business school for making it a great environment and for really enjoying my time here. And I'm able to hopefully do some interesting research because of it, I hope. Now, it's interesting with inaugurals, and when I was invited to give my inaugural, I decided, out of all these publications that I've got and the ones that are pending, what do I actually give? What do I actually present? And I thought to myself, well, what I would really like to do is present something that's relevant, given the impact in the ref that we got with Brighton, and something that we can hopefully all be able to understand and all be able to relate to, whether we are professors of finance or whether we are people within the community. So what I've decided to give is one of my pieces that I think is extremely relevant, which is a new methodology that I've basically derived, which is very simple to use, very simple to understand, but more importantly, something that, in my opinion, is superior to everything else that we've got in modeling liquidity. And when applied to the recent events of the credit crunch of 2008, actually forecasted the lack of liquidity, which the existing measures did not do, and we all know the consequences. So the idea is that it's going to be quite a relevant piece of work that's very much applied to real data, and that very much is something that we can all relate to. Hopefully we can all understand and we can all apply this kind of method, and therefore we can avoid the problems that we had in 2008. So this is the idea behind it. So what I'm really going to discuss, first of all, is this concept of liquidity. What is liquidity? It's a very, very good question. Liquidity is one of the most researched areas in the world of finance. I read a very interesting article the other day, which was in the top 5 finance journals. Approximately 68% of the publications are on liquidity. Why? Is liquidity so interesting? Well, not really. The reason that they're on liquidity is nobody can define it, and nobody knows what liquidity is. So it's a very interesting idea because there's a very, very big debate as to what liquidity is, how it's defined, and what measures we use. Therefore, the research is very, very interesting. And I'm going to briefly go through different definitions of liquidity that authors have found. And really, I'm going to go through each one, and then we're going to come up with the one that's the most commonly used, which is something called the Ammerhood ratio. And this is what has been used in light of the financial crisis to predict liquidity and lack of liquidity. And in fact, not only am I going to go through it, I'm actually going to plot some data. And I'm going to show how it fails, not only with the financial crisis, but with events of the last 20 years. And then I'm going to present to you my work and how we're going to take the existing measure, modify it slightly, and show that it actually works both theoretically and empirically, and the fact that it can actually predict the financial crisis. And as a result of that, I'm very proud to say that it's actually used by policymakers in the Bank of England in their financial stability report. We were able to present something similar, and they use our method now instead of the Ammerhood ratio. So when there's a next financial crisis, unfortunately, you can blame me. I'm not sure I should be presenting this after all. So that's the idea behind it. And then we will do quite a rigorous academic study on this through asset pricing. I'll explain the logic behind it. So not only are we able to show that it worked for the financial crisis by plotting it, we did a rigorous sort of academic exercise on excess returns, and we actually showed that our method was superior to the existing measure, which was the Ammerhood ratio. And then finally, I'm going to give a conclusion and further research. I've made it non-technical, and I'll try to make it as intuitive as I possibly can. So, liquidity. Well, liquidity is very, very interesting. I remember when I started my PhD, I'm going back now to 1999, when I was a young man, I looked at liquidity because liquidity was really, really interesting. And the recent credit crunch of 2007 to 2009, which peaked in 2008, was all about liquidity and lack of liquidity in the market. There was a liquidity problem, there was a bubble, there was a lack of liquidity. And it's been a very interesting thing for years, both at the macro level, when you're aggregating everything, either through a stock exchange to see if there's financial stability, or through a housing market, through a credit bubble, or whether you're even doing it on individual assets, which is called micro liquidity. It is a very, very fascinating issue. And the global financial crisis of 2008 simply highlighted the importance of this issue and why we should be looking at it both from a practical perspective and from an academic point of view. So, market analysts, traders, financial press are a main focus that liquidity is a main driver of asset prices. Now let me explain that a bit more. We are obsessed in finance with hedging our portfolios. We always want to hedge our portfolios. Now, in principle, we should almost be continuously trading because, as we know, portfolios are based on statistics and statistics of hedging, like negative correlations between one asset and another. And we know fundamentally that as we trade, we have more and more information. We are able to get a better position in the market. What stops us trading is liquidity, is the fact that we have to pay costs in order to trade. Costs that we have to pay to market makers to trade with us. Transaction costs, we may call them. So therefore, these transaction costs are a main driver of asset prices. It's interesting because I did a piece of consultancy for Fidelity Investments, and what was interesting is there was a whole philosophy on international portfolio diversification, yet most of the stocks are pretty much the liquid stocks that we all know, simply because of the trading costs being so small that they're able to continuously trade them with little effect. So again, liquidity is a big driver here. So very interesting to look at it. And of course, central banks and regulators are looking at it from the point of view of financial stability. I'm really going to focus on this because one of the big things about this piece of work is the Bank of England. The Bank of England have what's called the Financial Stability Report, where they basically forecast if there's liquidity or not in the market. They were using their report and they were using the previous measures and they got it horrifically wrong. We presented our work and now they use our measure. So it's really important from a perspective, from a financial stability sort of policy perspective, regulation perspective. So again, liquidity has been this really, really big issue. So, but the problem is that a lot of studies, I mean, I'm going back really now to the early 1980s. People, people who are interested in finance, and my colleagues will tell you this, is if you look at all the very famous models of finance from the 60s onwards, really, they just assumed that there was no problem of liquidity. Everyone ignored it, yet everyone knew it was really important. Well, the obvious question is why? Well, the reason that they ignored it is because, to be fair, for many years they didn't have data available to actually measure transaction data. Things like Bloomberg, things like DataStream, they didn't really occur those years. So in a way, they were forced to sort of ignore it. Now, it's a very interesting paper. Amihud, who used the previous measure, and Mendelssohn wrote a very interesting theoretical piece around 1981 that said that it's really important to look at liquidity, but we lack data. And of course, since then, we're able to obtain really good data, and now we're able to measure it. So that's essentially what went on. So we know it's very dominant. We know it's dominant in terms of practically. We know it's dominant for traders. We know it's dominant for international portfolio diversification, for regulators, central banks, and also for the academic literature. So by doing a piece of work like this, not only do we get a good publication out of it, and it's great for impact, we also have something that's relevant to the real world that people can use, and that people can apply, and that people can cite. So the obvious question is, how do we measure this thing called liquidity? Very good question. I could have a debate with you for hours upon end about how you measure liquidity and about different perspectives of what liquidity is and how it's measured. Right? In a nutshell, the very basic definition, without going through any academic literature, is the following. You want to trade the share. For you to trade a share, so you want to buy a share, somebody needs to be willing to sell you that share. There's a market. These people are called market makers. So the idea is you want to buy a share of Marks & Spencer's, somebody needs to sell you that share at a certain price, and then the opposite occurs if you want to sell. So every time you trade, there's something called a market maker. The market maker provides the market, and for that compensation, they get what's called a bid-ask spread. Right? And that bid-ask spread is their compensation for providing the market. And there's various ways to model this spread, and it's dependent on a lot of factors, like the volatility of, the more volatile something is, by definition, the spreads will be larger. For example, if something is not traded very frequently, market makers will charge a big spread because they might be left with it for a long time. Things like turnover ratio, trading speed, and so on. So there are various factors. But the basic definition of liquidity is exactly that. Technically, if I'm going to use Campbell's definition from 1987, it's going to be the ability to trade quickly, anonymously, and with little price impact. Right? So that's the basic idea, as a very sort of basic understanding of what liquidity is. So, and again, I mean, it's exactly what we've been saying. There are several dimensions of this. Trading quantity, obviously the more you trade, the higher the quantity, obviously the more liquid the asset is, and therefore the spreads will be lower of market makers. Trading speed, frequency of trading. Trading cost, the actual physical cost of trading the asset. And price impact. Trading cost has to do with the functionality of the stock exchange and how well established it is. For example, trading costs on the London Stock Exchange or the New York Stock Exchange are very low. Trading costs on emerging markets will be very high because they don't have the infrastructure. And this thing about price impact. You know, something is liquid when after you've traded, it doesn't significantly change the price. We all know this with things like Black Wednesday, for example, when the UK left DRM, speculators made a lot of money because they're able to change the price of the pound by trading huge quantities. So price impact's important because price impact basically says that your trades do not actually significantly change the price after they've occurred. So things like trading volume and price impact go hand in hand. If trading volume is really large relative to the total number of shares, they will have a price impact and they will affect the liquidity. If it's low relative, then it won't. So there are all these factors that are playing around. So again, this is the point. The result is that there's lots of measures and each of them have their attractiveness and their shortcomings. Now, I could spend hours going through this. I'm going to go through some fundamental papers in non-technical terms about how they measure this concept of liquidity. So if you look at the first three, they're all to do with this thing called the bid-ask spread. So there's the classic paper by Ammerhood and Mendelsohn on the bid-ask spread, which is exactly what I said earlier. The idea is that you've got a market maker, you want to buy a share, they sell you a share and vice versa. They post what's called the bid price and the ask price. The ask price is above the bid, ask minus bid is equal to the spread, and that's their compensation for the financial market. So essentially they provide you with a market, they're able to post an ask price and a bid price, ask is bigger than bid, and the deviation between the two is what's called the bid-ask spread. And that's their measure of liquidity. And what that measure should be depends on things like the trading quantity, on the volatility of the stock, how large the stock is, and so on. So that was the original definition from about 1986, this concept of bid-ask spreads. And then, of course, we all looked around for spread data, and we tried to look at that as our measure of liquidity. The higher the spread, the lower the liquidity, and vice versa. Because if spreads are high, it means that we trade less because it costs more to trade. And there's these market makers that come about with these spreads. And then you've really got the relative spread and the effective spread, which are basically extensions of the original paper. All relative spread is, you take the ask price minus the bid, and you divide it basically by the share price. So it's relative to shares. And effective spread basically says that you use intradaily data to do it at the time of the trade. So it's all spread measures, but they're slightly more sophisticated. Now, the problem with spreads is really twofold. The first problem with them is they do not measure long-term financial stability. Okay? Because spreads are all about each individual trade, because each trade has a spread. And they're great for capturing news, and they're great for capturing the impact of an individual trade. But over a long period of time, just by taking spreads and taking some sort of mean will give you absolutely no information. And they really found that once people started analyzing these spreads. So as a result of that, people started looking beyond the spectrum. And they looked at things like trading volume, which is an obvious one. Trading volume is basically the number of shares traded. Obviously, the more that you trade, the more liquid your stock is, and the less you trade, the less liquid it is. That makes some sort of more sense, because you can have a look at a trading volume, an aggregated trading volume or a standardized volume of an index, for example, throughout a period of time, and then that will give you an idea of the liquidity of the market, much better than these spreads. So the spreads are still used, but they're used on impacts of individual trades or impacts around news. They're not used for long-run financial stability by regulators, by policymakers. Trading volume is seen as something more interesting. So, and then you've got the turnover rate. Turnover rate is basically, well, in accounting terms it's sales, but in financial terms it's pretty much number of shares traded divided by number of shares outstanding. So that gives you a bit more of a perspective of things like trading speed and frequency of trading and things like that. So it's a bit more sophisticated than trading volume. And then you've got other measures like, for example, the number of zero return days. So in extreme circumstances, stock prices basically don't change. That's what a zero return day means. The stock price was the same as yesterday, so you get a zero return. And the idea of that is that if you get zero return, that could possibly be because you've got some sort of crash in the liquidity. So the liquidity is really large, and as a result of that, you don't trade, and therefore the price is the same as yesterday, and you end up with a zero return, because returns are just changes in prices. And then you've got, sort of sensitivity analysis to things like order flow ratios. So, how sensitive we are to these turnovers, how sensitive we are to these trading volumes. So you've seen here how we've gone from this spread measure in the mid-1980s that was seen as really important to these more general measures that capture liquidity and financial stability in a much more broader sense, sort of mid to late 1990s. And that's really where the literature's sort of gone. And we sort of said no measure can perfectly capture all dimension of liquidity, but the one that is pretty much used is the Ammerhood ratio. Okay? As you've probably noticed, Ammerhood was the original paper of 1986 with the bid-ask spread, but the Ammerhood ratio in 2002, which is this one here, is essentially the one that people use for any type of financial stability analysis, any type of policy analysis, any type of analysis to tell us if we have liquidity or not in a broader sense in a financial market. The spreads are still used for individual news and individual trades, but this is the broad definition. So let me try and define this for you. What you basically have is this RTO-VIT is what's called a price impact ratio. That's what it's called. Now the idea is this. You take absolute returns. So you take returns, and returns are deviations in share prices, change in share prices, and you take the absolute value. So for example, if the return is minus 3%, it will be 3, right? The absolute value. And you divide that by the trading volume, which is the VIT. So the way you would estimate this is the following. Say you wanted to do this over a trading day. You would take the absolute return either as an average during the day or at the end of the day, and you would divide that by the trading volume. That's what you would do. And essentially, you can obviously do this over these days, trading days. And you can, of course, do this, and you can add up the different days and divide by the number of days. So you can play around with this. You can do this intradaily, if you wanted to. You can do this day by day. And then you can add up the amount of days, and then you can take an average. And this is really what's used. So it's absolute returns divided by trading volume. You do it for each day, you add up all the days, you sum them together, and you divide by the number of days, and you end up with some sort of liquidity measure. And this is what they do. Now, technically, this is called an illiquidity measure, simply because of the definition of the equation. You're dividing by trading volume, so by definition, if trading volume is large, you have liquidity, and the ratio is small. So it's an illiquidity ratio. So in other words, if the ratio is small, you actually have liquidity. If the ratio is large, you have illiquidity. Simply because by definition, you're dividing by trading volume, and if trading volume is large, the ratio is small. That's just by definition how it works. This is what people use. If you pick up any paper, this is what they'll use. They'll use the Ammerhood ratio. So, and then you've got absolute returns daily, trading volume, number of shares traded on a particular day, averaged over a monthly horizon. Doesn't have to be a monthly horizon, it can be annual, that's up to you how you average it. But that's generally what people use. Now, the obvious question is, why do they use this? Why have they picked this measure instead of all the others that I went through on the previous slide? Well, the point is this. It's easy. It's easy to compute. And that's really my point here. It's easy to get data, it's easy to compute, and it gives us an idea of what's going on. So if I just go back to the previous slide, and we go back to the equation, you can see how easy this is to compute. You don't have to be a finance expert to compute this equation. You can do it in Excel, you can do it on a calculator. Trading volume is easily available, returns are easily computed, absolute returns. You can add them all together, you can divide. We can get data for long horizons. It's easy to download, it's easy to compute, and it's really easy to interpret, right? We know if the ratio is small, it basically means that we've got loads of liquidity, and we know if the ratio is large, we've got loads of illiquidity. It makes sense. These are policymakers. These are not professors of finance. These are not professors of mathematics. So it makes perfect sense why people use it. It's intuitive, it's easy, and that's why people use it. And hence, that's exactly what Kerry used in 2008 in their financial stability report for the Bank of England to predict the financial crisis, and what all policymakers use. It's easy, and it makes sense to compute. So that's why people use it. So now the obvious questions here are, what are the problems with it? Why are we here to give this inaugural? Well, there are problems with it. What I will do first of all is I will go through the problems that it's got theoretically, and then I will show you empirically how it doesn't work. And then I'll apply it to the financial crisis, and I'll show further why it doesn't work and why we need something else. Well, the obvious one is it's always going to appear liquid. Because if you think about it, if you are a policymaker, you inevitably try to compute financial stability based on some sort of index that represents your economy, like the FTSE All-Share or the FTSE 100, because 80% of the trading in the FTSE 100, it represents the entire stock exchange. Inevitably, you will do that. So by definition, if you are looking at these type of firms that are listed, they're large firms. Well, large firms have large trading volume. And if you go back to the ratio, that means that you'll always have liquidity. Because if trading volume is large relative to absolute returns, right, the ratio is going to be small. And therefore, it's got a size bias. And that size bias will automatically give you a bias in your results. So even if you're looking at a financial crisis, you will show that you've got liquidity because it's based on these large firms. So there's a size bias. And that's the point. So, and that's a real problem with this. It's got a huge size bias. The other thing about it is it neglects investor frequency of trading. It neglects that. Well, this neglects everything in finance. We are obsessed with high frequency trading. This is why we're always speaking to Aidan to try and get a trading rule, because we're obsessed with high frequency trading, right? It's all about trading all the time. We know that. We know it's the in thing. We know it's all about high frequency trading, hence why people are picking stocks with high liquidity, so they can trade them very quickly. We know that. Well, another problem with the Amberhood ratio, it doesn't take into account frequency of trading. So we know high frequency trading is really important, it doesn't account for it. And we also know that it's got a bias towards large firms. So I've got a problem in using this. If I use it, I'm always going to get liquidity. Well, not always, but I'm always going to get a bias towards liquidity, right? And I know that it's not accounting for high frequency trading. Yet I spend all my time talking to my students and writing papers on high frequency trading. And my liquidity measure doesn't encapsulate that. And that's a problem. And the third issue is it's got what's called a price level bias, which is not a huge issue because that one has been accounted for. In that, if we have a look at the empirical evidence and if we plot trading volume over time, you'll find that there's an upward trend in trading volume. People tend to trade more frequently over time. There's a reason for that. And the reason for that is to do with the fundamentals of stock exchanges and how they've traded. In the old days, before 1997, you could only trade with a market maker. Simple. So I wanted to buy a stock. I had to trade with a market maker whether I liked it or not. It was called a quote-driven system. Since 1997, and this is the London Stock Exchange, we started first, and by sort of 2003, all the stock exchanges followed. We are now able to post limit orders. So in other words, I can see on a screen that the market maker will trade at this price, but there's another investor who will trade at this price. So therefore, because of that, trading volume increases because we are able to, market makers, if they want to be in the game, are more competitive. Spreads on the whole are getting smaller and there's more trading frequency, hence high frequency trading. But that also means that trading volume is going up through time. By definition, it's got an upward trend, right? It's trend driven. And because of that, you have to account for that. To be fair, the Bank of England did, in their report, the financial stability report, account for that by dividing through by market value to remove the bias. So this is not a big issue, but the first two are. The size bias issue and the trading frequency issue were problems with the Ammerhood ratio. So, I mean, you can see this in the graph. I mean, it's pretty obvious. If you plot this with real data, you've got trading volume on the x-axis, and on the y-axis you've got market value in millions. It's a direct correlation. Yeah, large firms are traded very frequently. Why? Well, we know all about ETFs, exchange traded funds, right? And essentially, we know where a lot of the money is going on these assets. It's practical correlation of 1. So we can graphically see exactly what's going on. It's basically pretty much a perfect correlation. This is simply a scatter plot. You can automatically see this huge bias towards the large firms. So this is if you plot the raw data of market value versus volume with, this is essentially firms on the London Stock Exchange, which I've got data for. And this is doing it with respect to the Ammerhood ratio. Well, again, this will be, of course, negatively correlated because the Ammerhood ratio is absolute returns divided by trading volume. So obviously, you're going to have a negative correlation if you do it with the Ammerhood ratio on the y-axis and trading volume on the x-axis. So you can automatically see practically perfectly negative correlation. Well, it's obvious. So an obvious question, and when I gave a presentation, a bit more technical, but I gave a similar sort of thing in the Bank of England, they said, well, okay, fine, Andros. Yeah, academic papers are written all the time, right? And we are very, very good at criticizing each other, make a living out of it, right? All of us. Who cares? I mean, who cares? I mean, okay, you found something. Does it matter? So the obvious question is, when we apply the previous measure to real data, does it work? Because if it works to some extent, there's a bias. I appreciate that. It's great for academic research, but it's not going to have the impact, right? If it doesn't work, then we need a new measure, which is obvious. And this is what I want to show you, which I think is really, really interesting. Now, what have I done here? What I've done is I've calculated a sort of an index, a value-weighted index of all the firms, right, that are listed on the London Stock Exchange. So these are international companies, right? And I've basically plotted the Ammerhood ratio, so the ratio that, this ratio that everyone was using before, and I've plotted it, and I've tried to do this as best as I can. I've tried to pick significant events that have occurred since the early 1990s that have had a huge impact on liquidity, both positively and negatively. And I've tried to see if the Ammerhood ratio can actually predict these events, which we know, and we know the impact they had. So let's start with 1992. We all know about 1992. We all know this is when the UK left the RM. We all know all about Black Wednesday, right? What happened? There was huge liquidity in the market. We know that, huge liquidity, because the UK left the RM and people were trading and making billions of pounds on that, and hugely destabilizing the economy. It's not picking that up at all. Because remember, this is an illiquidity ratio. So if the ratio is high, it means that essentially there's lack of liquidity, right? It's not picking it up. Let's take another event. Around 1994, 1995, Mexican currency crisis. Huge devaluation of the Mexican currency, huge trading because of it, not picking it up. Picking up slightly more, but not really picking up. And then you've got Asian crisis, late 1997, about 1997, 1998, where you had the house market bubble which burst, and you had the crisis in Japan. Both these crises provided huge liquidity problems for the world economy. It's not picking it up. It's showing liquidity. The ratio is small. And the more recent one, the credit crunch. It failed miserably. There is no doubt that this failed. There is absolutely no doubt that nobody predicted what was going to happen. Why? Because they used a measure that was basically wrong. Right? You can have a look at it. It's pretty obvious. It shows that we didn't have a problem with liquidity when we clearly did. There's huge liquidity according to Ammerhood, and we know there wasn't. And it's got it wrong pretty much on every occasion. When I presented them with this, then they listened to me, because then we had something interesting. This measure was incorrect, and there had to be a new measure. And And that's the basic idea. All this is showing you this slide. I'm not really going to go through this one. All this is basically showing you is that it's showing you theoretically why it's important, but we don't need to go through that slide particularly. So, now the obvious question is, okay, you've shown that Amihud doesn't work, fair enough. Well, do we have anything better that we can use? Or do we just stick with it? It's an obvious question. Can you solve a problem? Well, the point is this, and I remember this because I was at this lecture. One of the biggest names in finance is Eugene Fama, and Eugene Fama's co-author is French. Big names. And it was really interesting this because I went to his AFA, presidential address, and he's a very, very clever man. And what he said was interesting here. He said this: turnover. He said, we need a liquidity measure based on turnover. But the previous measures which I showed you a few slides ago were just based on turnover. We need some sort of ratio based on turnover rates. Because we know that turnover is what's driving stock markets. Look at the data. Turnover, which is defined as number of shares traded divided by number of shares outstanding, was approximately 40% in 1995. It's about 153% in 2008. And now it's gone up to nearly 200%. And he actually said that. He said that in his presidential address. That automatically gave me the idea of this ratio. And this is what we do. Now, we had a challenge, a big challenge. Now, the challenge we had was the following. We didn't want to write another academic paper. We didn't see the point in that. We wanted to write a paper that people were going to use, that there was going to be impact, that the Bank of England was going to use instead of the Amihud ratio. So we needed to make it simple. We need to give it all the same intuition as the Amihud one did. In other words, data is available. We're able to compute it easily in Excel. We're able to understand it and what it means. Because if we don't have that, people won't use it. And if people don't use it, okay, we can get a publication out of it, but it defeats the purpose. So we had to take the Amihud and derive something that was basically just as easy to compute, just as easy to understand, but something that worked. The key was turnover. So all we did, very simply, is we took the Amihud ratio, and instead of dividing it through by trading volume, we divided it by turnover ratio. And turnover ratio is the ratio of daily trading volume to the number of shares outstanding. It works exactly the same way as Amihud. So in other words, if the ratio is small, we have liquidity. If the ratio is large, we have illiquidity. Hence, it's an illiquidity ratio. You can get turnover rates just as easily as trading volume. You can do it in Excel. We can all understand it. And it's got turnover rates in. Turnover rates are really important. Why are turnover rates really important? Because they are the whole concept that's driving high frequency trading. The idea of frequency of trades. And that's what turnover's picking up. That's exactly what French said in his presidential address. So we're able to capture that frequency of trading, and we are able to have all the advantages of the Amihud ratio. So the obvious question is, does this work? So now I'm going to go through theoretically why it works, and then I'm going to apply it to financial crisis. Again, it's got all the advantages of the Amihud ratio, but it's free of size bias. It's no longer the case. You don't have this perfect correlation between large firms and trading volume. Turnover ratio has absolutely no correlation with market capitalization. We'll show that on a graph. Absolutely none. So you don't have this size bias. That's the big advantage. The other big advantage is it doesn't have price level bias. I know that wasn't a big one, but the fact is trading volume's always going up through time. It's got an upward trend. We don't have any of that. There's absolutely no reason why turnover ratios in financial terms should be going up year on year. They don't have this price. And the important thing is it encapsulates high frequency trading. That's the point. It's capturing that in the ratio because it's number of shares traded divided by number of shares outstanding. If that changes, it's capturing trading frequency. So we're encapsulating trading frequency. We've got rid of the size bias, we've got rid of the price level bias, but we've kept the big advantages of Amihud, which is that it's easy to compute, easy to understand, and everybody can, and we're able to basically apply it to real terms. So we've got that, and we're getting really excited now. And that's the point, easy to calculate. And this is simply showing you a scatter plot of turnover ratio versus market value. And as I said to you, there's absolutely no correlation between turnover ratios and market value. You can see that, purely as a scatter plot. And again, so this is doing it simply turnover ratio versus market value, the raw data. And this is doing it for our ratio versus the market value. Again, there's absolutely no correlation. So there's no size bias. We know that. And we know that we're encapsulating trading frequency by definition through the turnover ratio. And we know that there's no price level bias, because if you actually do plot turnover ratio over time, you find that it's really scattered. And that actually it's got no price level bias. So clearly it's got all the advantages of Ammerhood and it gets rid of all the disadvantages. But the $1 million question, and I'm sure we've all done it when we all do research, is does it work with real data? If it doesn't, you've got a problem. And this is what we've done. Right. So the blue line is essentially our ratio. The red line is exactly the same as the previous slide when I showed the Ammerhood. So the Ammerhood ratio, the previous measure is the red line, exactly what we said. So let's just go through the red line again one more time. It looks like essentially there's lots of liquidity in the market when the UK leaves the RM, which we knew through Black Wednesday wasn't the case. We know that when there was the financial crisis, the credit crunch crisis around 2007, 2009, there was a lack of liquidity. The Ammerhood ratio is showing liquidity. And also the Asian financial crisis, we knew there was a huge lack of liquidity, yet it was showing liquidity. Our ratio appears to work. Let's take an example. UK leaving the RM, Mexican currency crisis, there's liquidity in the market. Asian financial crisis, late 1990s to around 2002, lack of liquidity. Financial crisis, credit crunch, 2008, 2009, lack of liquidity. It works. No doubt, it works. I'm not saying it's perfect, and I'm sure there's more to be done on this, which is exactly what we're doing now, by the way, but it definitely works. So there's absolutely no doubt it works. So we've got something, and it works. And at this point, the Bank of England took notice. And this is just showing you our ratio versus spreads. And as I mentioned to you before, spreads don't really work because they don't capture long-run horizons. So that's what that's showing you, which is not that important. But the key to this is, when we got to this stage, and when we did this, the obvious question, and as we all know, being academics, most of us, is that in order for this to be regarded as the measure to use, you need a bit more than this, right? You need a proper econometric analysis, which we love to do in academia, and that's what we did. So we did this, so as well as plot this, we took it to the next level. What we did is the following. We took every single stock on the London Stock Exchange between 1991 and December 2008. We are doing this now for the US market. We are doing this for emerging markets. We are doing this for bonds. This is ongoing research. And we got daily data, okay? And we got it from DataStream. We got daily data. Why did we get daily data? Because this is computed by essentially central bankers. This is computed by governments. This is computed by policymakers. So they're looking at long run horizons. So you do it over daily and then you aggregate it out. Exactly what the Ammerhood ratio did. And what we did is we took portfolios and we sorted them. So let me explain this to you. This is the Ammerhood ratio, the previous measure, not our measure. Now let me explain what's going on here. There are 10 portfolios. Why 10? It doesn't have to be 10. There has to be some portfolios. You can do 10, you can do 20, you can do 30, right? And the idea is that these portfolios are basically sorted by essentially liquidity, okay? By the Ammerhood ratio. So in other words, the idea is that what you've basically got is the P10 ratio is the one that's the less liquid, and the P1 ratio is the one that's the most liquid. So what you would expect to get according to financial theory is the following. If you take the two extremes, which is P10 minus P1, you should basically find positive and significance. Why? Because you're an investor. You are not gonna trade a stock that's got low levels of liquidity unless you are being compensated for it, because you can't sell it unless you encompass a really large cost, right? So what we've basically done is we've taken portfolios and we've sorted it. So we've taken all the data and we've sorted it into 10 portfolios, into 10 quintiles. And then what we basically say is if we take the two extremes, and we've done different versions of this, by the way. If you take the two extremes, you should find positive significance. Otherwise, you are not being compensated for liquidity risk, which makes no sense. And look at the results, and the results are very interesting. If you look at it from the perspective of equally weighted returns, Amihud works. Okay? So in other words, if you are looking at everything equally, so if you simply take in a mean, right, then Amihud works. You get a T ratio of 3, it's above 1.96, significant. But that's not true. You can't look at equally weighted returns, they make no sense. Value weighted returns make sense because it's all about how much the trade is with respect to the value of the company. 100,000 shares in Apple is not the same impact as 100,000 shares in an SME, by definition, right? And if you look at the value weighted returns, it doesn't work. Yes, it's positive, but it's a T-stat of 1.5. It's below the critical value of 1.96. It's insignificant. So this shows you further that the Amihud ratio just doesn't work in any stretch. So of course we did exactly the same thing with our ratio. Now all we've done here, again we've picked 10 ratios. Here, so the idea is that again here, P10 is the one that's the most liquid and P1 is the one that's the least liquid, and we did P1 minus P10 and it works. For both equally weighted and more importantly value weighted, you're getting returns, you're getting compensation, and you're getting significance. So you are being compensated for liquidity risk. Of course you are. You are never going to take on a stock that has a high trading cost unless it's got higher potential returns. Otherwise you would never take it on. It's basic efficiency from FAMA 1970. So clearly our ratio works. And that's exactly what we find. Now, 2 more slides and then I'll conclude. Now what we've then done, and this is for people who are into sort of finance. In finance, we've got a huge literature on asset pricing. You know, how do you price returns, right? How do you know how you price returns? And we go back to the 60s with CAPM, which basically says that returns are all a function of this thing called beta. And beta is simply the risk of your stock relative to some sort of market index, market portfolio. This is the classic CAPM. So this is what's denoted here as CAPM alpha. And then since sort of 1996, Fama and French have come up with a 3-factor model that also includes basically firm size and book value of assets. So in other words, returns are a function of this beta and also book value of assets and firm size. And then you've got the Carhart model that takes the Fama French model and adds on to that momentum of trades, okay, in 1997. So we say, well, wait a second, if liquidity is really important, right, surely liquidity should be a factor in this asset pricing model. Because if you are being compensated for returns, right, as an investor, well, it's got to be in an asset pricing model. So let's add the Amihud ratio to this and see if it works. And again, these are our 10 portfolios, and we're looking at the extreme cases, 10 minus 1. And what do you find? Look at the T-stats, which are in the brackets. None of them are above 1.96. Liquidity is not driving asset prices. Liquidity is not important in determining returns. Okay? And this is as rigorous as you'll get in finance, because these are basically how we price returns. Okay? Forget even the graph, forget even the financial crisis. This is how we do it. We take the 2, the 3, the 4-factor model. Really, we're at the 4-factor model, but we do the other 2 as robustness, and we add the 5th factor, which is liquidity. And liquidity is not important. That's exactly what we're finding. So then the next question is, if we do the same analysis with our ratio, what do we get? Positive, significant. The lower the liquidity of an asset, the higher the potential returns that you get, because liquidity is itself a risk. It works with the basic CAPM of the 60s with just beta. It works with the 3-factor model that includes on that firm size and book value of assets, and it works with the 4-factor model, which is momentum of trades. So what have we found? We found the following. We've gone through the liquidity measures. We've shown that the Amihud ratio, which was previously used, fails miserably. It failed with the financial crisis. It failed with all the major events of the last 20 years. And it fails in determining returns of stock prices, which is what we're all trying to model. And it fails in every way, in every model. We have found a measure that, number one, is easy to compute, number two, is intuitive and we can all understand it, and number three, it works. It worked graphically with events of the last 20 years, and more importantly, it worked with asset pricing. At the end of all this, what have we got? We've got something that policymakers are now using, hence the citations on ResearchGate. We've got something that has created big impact. And in the academic literature, we've added a fifth factor to the CAPM, which we think is really interesting. So we no longer have a four-factor model, we have a fifth-factor model with liquidity in it. That's what we've got. This work is this idea, this concept is being worked on constantly. We are doing it for the US at the moment. We've got some results. We're sending it to a journal. We're doing it for emerging markets. We're doing it all the time. We're doing it for bonds. We think we've got something interesting. We want to try and hopefully publish a few more and try and build a case study for the ref if we can as well, because we think it's really interesting. That's what we're doing. And with that, I will end the inaugural. Thank you.